Everyone, and thank you so much for joining us during your lunch hour. I'm Edwin, Senior Client Advisor here at Endowus, and also we have Yulin here with me today, our investment lead. Today we're
Hi,
very excited. Yes, thank you, Yulin. And today we are very excited to share more about our new income up portfolios. These are a set of three bond-focused portfolios that offer investors a convenient and effective way to meet their unique passive income needs at different life stages. In a single investment portfolio, investors can get exposure to diversified sources of income with payout targets of up to 7.5% per annum, with no lockup periods, subscription or withdrawal fees, and with the usual Endowus promise of 100% cashback on trailer fee commissions. So just very quickly showing our usual disclaimers. So if you have any questions today, please go to Slido, and the link is sli.do, and type in income up. So you can put all your questions there. So that's sli.do, and the code is income up. So just very quickly, for those of you who are new to Endowus, our mission here is really to empower all of us to invest better, to live better through a conflict-free advice, institutional access, and also low-fare fees. We're also backed by major institutional investors such as UBS, Citi, MUFG, as well as venture capital funds like Lightspeed, SoftBank, and government-related entities like EDBI, as well as prominent Asian families that have invested in Endowus unique fee only and also conflict-free business models. And this is the growth journey that we've been on since the launch of the company. We officially launched in 2019 and became the first and right now the only digital advisor for CPF in Singapore in 2021. We also acquired a majority stake in a Hong Kong wealth manager called Carre Private to become one of the largest independent wealth managers in Asia, managing over $5 billion in assets. And our most recent fundraise last year saw us raising $35 million despite a challenging economic environment. Our existing investors participated in this capital raise, and we also brought in a few new investors onto our cap table, including Citi, MUFG, and also a couple of large family offices. So on our platform today, you can access some of the world's leading fund managers and often at the lowest cost possible, as we offer institutional share class where possible or rebate trailer commissions as cashback. We believe Hong Kong investors deserve to pay lower fees and also keep more of your returns. You can invest in these funds or even transfer your existing holdings to us and enjoy multiple cost savings on Endowus. So Endowus was really designed as a goals-based platform where we want to help clients invest towards their financial and life goals. We believe that your different goals in life, whether it's saving for rainy day fund or your retirement or your kids' education, should have different time horizon or risk tolerances and therefore should be invested in different portfolios. So every Endowus portfolio is designed by our investment office, a 12-people team of investment experts, screening the entire universe of funds and curating what we think are best in class for our clients. So the new income up portfolios are designed to distribute monthly passive income, while the Endowus core portfolios are designed for medium to long-term wealth accumulation. And we also offer Endowus satellite portfolios that are thematic and suitable for expressing specific tactical views. For instance, if you're particularly bullish on technology stocks. And the Endowus Cash Up portfolios are designed for short-term cash management and rainy day cash. And with that, let me ask our investment lead, Yulin, the first question of the day. Could you please explain to our audience what is income investing?
Yeah, thank you, Edwin. And I think this is a great question to start our session today. I assume that most of you who are listening are actually quite interested in the idea of income investing, but it is important to set our expectations right on what exactly is income investing. So I think to know what is income investing, we need to understand how it is different from other kinds of investing, such as the typical growth investing. I think to begin with, the investment objective is very different. So, income investing prioritizes generating current passive income on a regular basis, whereas growth investing prioritizes long term wealth accumulation. And you can't maximize both. If you want more income now, you will have to compromise on long term growth and vice versa. And secondly, because of different investment objectives, the investment approach should thus be different. So, for example, any portfolio's return is generally driven by two components: income in the form of dividends if it's stocks, or coupons if it's bonds. And the second component is price appreciation or depreciation. So for an income portfolio, the investment manager will gravitate towards instruments that generate a return that links towards income. Examples of such instruments include bonds, dividend generating equities, or sometimes even option writing to get the option premiums. So in a nutshell, how it would look different to you is that income investing withdraws income from your investment pool to satisfy your current need of having this stream of cash flow, whereas growth investing reinvests income back to the investment pool so that it actually compounds over time. And to illustrate this, I have drawn a very simple chart to show you how the cash flow will look like in your account. So for simplicity, we assumed 5% total return per year for both types of investing. And for income investing, 3% payout yield per year. Well, after 1 year, both portfolios would have grown to from $100 to $105. However, the income portfolio would pay out $3 to investors, leaving your account with 102 still invested in the portfolio, and you can take the $3 to spend on whatever you want. And at the end of the second year, the income portfolio will then grow to 107, while the growth portfolio, because it has started to compound on the previous year's return, would grow to 110, and this continues on. So the question is one type of investing better than another? Absolutely not. And this is what endowment means when we talk about goal-based investing. Ultimately, it really depends on your needs and whether the extra cash flow generated by an income portfolio will truly empower your everyday finances and enhance your overall investments. So there are some obvious reasons for people to actually go to income investing. And the most obvious benefit of income investing is that it generates that additional passive income to pay for daily expenses and financial obligations, such as your mortgages, car loans, insurance, etc. Additionally, it could also have psychological benefits, as the consistent income payouts would alleviate stress during tough times, either personally or during the drawdown of your own investments. And last but not least, income producing assets are generally more stable than, for example, growth equities. For example, bonds, they sit at a higher capital structure than stocks, and dividend paying stocks are generally more mature companies than your growth type of stocks that are, earlier stage companies facing more uncertainty. So allocating a part of your portfolio to income generating assets could help you reduce your overall portfolio risk and improve your diversification. So now that you understand the various considerations, there are many ways of implementing income investing. However, to be honest, Endowus has found that many popular income products on the market often fall short of investors' real needs. And this is why we have created the IncomeUp portfolios to provide a better alternative. So to go through the popular options quickly, dividend stocks I've mentioned, for example, REIT stocks, they are great and they do generate regular dividends with higher potential for additional capital gain even. However, they also carry really high volatility and concentration risk. Importantly, investors are at the risk of poor stock selections and may not be rewarded for these risks in the end. So single bonds, they are also great and they are more stable compared to stocks. They're good for regular income generation. However, purchasing single bonds requires a very high capital outlay. You can't just buy $10 of bonds. You probably need to put down 100K in order to just buy this one bond. And if you only buy a few single bonds, the risk you also has the concentration risk and also potential default by the bond issuer if you fail to pick the right bonds. And annuity plans, they are very popular for especially for retiring. So they provide regular income streams and some of them are capital guaranteed. However, they tend to have lockup periods and really high and non-transparent fee structures. They tend to be really complicated to understand as well. So you just get lost in all this structuring and don't really know what goes on behind the scene. Some of them would also pay income from the pool of capital that you have originally put down, which is fine if you're okay with it, but there might be better ways of doing it. And lastly, income funds offer better diversification because essentially what they do is that they pool all the investors' money together into this vehicle, and then they would use a larger asset base to invest in a diversified portfolio of bonds or stocks. However, if you only buy one income fund, you could be subject to single manager risk, and some investment platforms embed a trailer fee in the total expense. And this is really hidden costs. Like you will know, but you are paying for it. And that can eat into the eventual returns of your portfolio. So given all these limitations on the existing income products, we really felt a need to create a holistic solution that could properly address the income needs of all investors.
Thank you very much, Yulin. So now we have understood the purposes of income investing and also why people should consider generating extra cash flow through investing. Could you also please tell us a bit more how we design the IncomeUp portfolios and how is the fee structure when it's compared against accessing the same funds via other platforms?
Yeah, thanks, Edwin. So I'll start by answering the first question, and that is, how did we kind of come up and design the IncomeUp portfolios? So I think our starting point really is to consider the real world needs of the end investors. At Endowus, we serve a wide range of clients, and we understand that each of you are probably at a different stage of life. Some have just started a family, some are planning to retire, and some have just started a first job. And we have designed three IncomeUp portfolios to meet you where you are in that season of life. We have tailored the target payout level, risk tolerance level, and underlying allocations accordingly for you. So I will go through the three portfolios very quickly as an introduction, and we will dive deeper later. For IncomeUp Steady portfolio, it targets 5 to 6% payout per year. It is not an insanely high level, and because that's not the goal of this portfolio, being conservative, higher quality, and therefore offering stability of its cash flow is its primary focus. It is great for retirees or those really conservative investors who just want the peace of mind and steady cash flow. For IncomeUp Plus, It targets a higher payout target, 6.5 to 7.5% per year. And we achieve this by taking on more risk in the high yield space. Its goal is to maximize current income generation, and it is suitable for those who are still younger and working. Thus, you might have a higher living expenses to pay for, but you can also tolerate higher risk as time is still on your side. And lastly, the IncomeUp Growth Portfolio. It is the only income portfolio with a dual objective, so two objectives at the same time. It targets 4 to 5% payout while achieving some capital appreciation in the long term. Because of this, it has the highest risk amongst the three. So if you look at the asset allocation line, the other two portfolios are both 100% in fixed income. This portfolio is a balanced portfolio with 60% in fixed income and 40% in equities. I personally find it to be a really interesting portfolio for younger adults who want some income now to supplement, maybe their expenses, their hobbies, your gym, yoga, whatever. But you also want to build your long-term wealth to have the best of both worlds. Next page, please. So another key differentiator for the Endowus IncomeUp Portfolios is that we designed it to be multi-manager. So each portfolio utilizes top mutual funds managed by global reputable fund managers. And for the IncomeUp portfolios, we are working with 10 different fund managers. In total, they're super experienced. They manage more than 12 trillions of client assets and have more than 700 years of investment management experiences. So on average, more than 70 years per manager. And we believe that this multi-manager model is the answer to single security and single manager concentration risk faced by many retail investors, as I have explained earlier. Additionally, the mutual funds are also handpicked by our investment office. I am part of the investment office, so I know the process really well, and it's a really rigorous process. We scan the whole universe, working tirelessly to conduct in-depth due diligence and research, and we work really closely with fund managers so that we could actually provide access to institutional quality funds and portfolios for all the Endowus investors. And the last pillar I want to touch upon, and I think that answers your second question, Edwin, on fees, is that we really pay a lot of attention to lower fees. So it's ironic, right? When it comes to investment products, a lot of people overlook the aspect of fees. However, actually, this is the aspect that we have the most control of. It's very simple. Higher fees, lower return, and that's it. So as with any of the portfolios Endowus offers to our clients, we are very aggressive to lower the cost as much as possible, and we are also brutally transparent in our fee structure with our clients. What you see is what you're paying, and there's no hidden fees. And how we do it is that we either offer unique access to institutional share class, so those don't have trailer fees, and they are usually only available for really large institutional clients with like above 100 million kind of ticket, but we make that available for retail investors by working with fund managers. Or if the fund has hidden trailer fees, we give back 100% back to our clients, so we do not take any commissions. And here we have conducted an analysis comparing the net expenses for our IncomeUp portfolios versus if you were to buy the underlying funds on other platforms. So the cost saving is quite significant. It ranges from 64 to 67 basis points. And essentially, we're reducing your total cost by almost half. And that will really make a meaningful difference to your long-term investment return. So just to sum up everything that I have said, we approached the Endowus IncomeUp portfolios with a life stage approach, and we made it multi-manager, and we lowered its costs as much as possible.
Thanks again, Yulin. Maybe could you also walk us through a bit how is the composition of the income up portfolios, and what are the funds that made up each portfolio, and how is each portfolio allocating the investments?
Yeah, thanks, Edwin. Um, yeah, this is a very loaded question, so I will try to answer it with much structure and simplicity to not overcomplicate, the process. But I think when we think about portfolio construction, um, we start with the investment objectives, right? So from a bird's eye view, each Endowus IncomeUp portfolio is a portfolio of multiple funds. It's fund of funds, basically, a portfolio of funds curated by us to meet the defined client investment objectives. And we use a building block approach for portfolio construction. And each building block offers a unique diversifying stream of income. So I have listed out the building block on the left side column. And I just give an example. For example, for steady income portfolio, 75% of its income is generated by US focused flexible bond funds. Then the remaining 25% of its income is generated from Asia and emerging markets bonds. And then within the building block, further diversification is sought, such that there is no over-reliance on a particular manager's investment views and positioning to avoid that over-concentration risk that I explained earlier. Next page. So while the previous page shows you the ingredients and the recipe, this is the finished product. It is clear that the portfolios have been crafted uniquely and differently in order to deliver their respective income and growth results. So both steady and plus portfolios, they have 100% in fixed income, such that they can be purely income focused. However, steady has much less exposure to the riskier, higher yield bonds because it is meant to provide a peace of mind to retirees or to conservative investors. In comparison, if you look at the middle pie chart, Plus has more allocation to high yield bonds, increasing its risk, but also enhancing its payout target to be 1.5% higher than steady. And lastly, growth has in total 40% allocation to equities, such that it provides longer capital growth, higher capital growth potential in addition to current income. It has 20% in dividend-focused stocks to complement the income stream from bonds, and 20% in accumulating global stocks to really pursue that capital growth element of the portfolio. So I guess, Edwin, so I'm asking myself this question now, right? Cash yields are really, really high. And I have seen a lot of clients asking, hey, why should I go into an income portfolio? Why should I invest in fixed income or even stocks when I can just invest in cash, right? And this is a valid question, so I really want to address it here. Okay, so I think the bottom line is you don't want to miss the forest for trees. Right, so cash has been a great investment for the past 2 years, offering investors attractive yield. I think currently the US money market funds is still giving you 5%, and we do have those options on the platform, and they come with very little risk. There is risk, but it's low. However, one hidden risk of cash is reinvestment risk. So, what will you do when the interest rate finally comes down? The reality is that cash rates fluctuate quickly, and it is closely tied to the current interest rate environment. So, as we approach the end of the rate hiking cycle, with potential rate cuts on the horizon, investors must consider the potential consequences of declining cash rates. On the other hand, longer duration fixed income assets enable investors to secure higher yields for longer periods. better aligning with investors' medium to long-term goals. So I've put an illustration here, and I think it's very apt to describe the differences between cash and fixed income. Staying in cash is like purchasing a single bus ticket every day. You stay flexible, but you might face fare increases in the coming time. In contrast, fixed income is like purchasing a seasonal pass. You fix your price for the duration of the pass and don't need to worry about the fluctuation of prices in the meantime. So cash is great, but it's not going to be great forever. And while you still have the window of time when the rate is still high, fixed income can help lock in the current yields for longer than cash.
Thank you very much, Yulin. So the IncomeUp portfolios sound great. So before we move on to the last part, to the FAQ, I have one last question for you, which is, if I do decide to put my money into the portfolio, could you also show me how the portfolio has performed in the past? And I'm also concerned about how stable are the distributions on a historical basis as well.
Yeah, yeah, definitely. You have to prove the portfolio with numbers, right? um, Maybe we can go. Oh, sorry, we can jump maybe to a few slides later. Yeah, yes, this one. So, this is basically the historical performance and risk of IncomeUp portfolios. And to sum up, if you look at historical numbers, the IncomeUp portfolios have shown attractive risk and return profile compared to the respective benchmarks. And the three portfolios have either outperformed or performed in line with the respective benchmarks in the long term, while realizing less volatility and downside risk. At this juncture, looking at the long-term numbers, actually you might be thinking, wow, the long-term return looks really low, right? I hope this does not discourage you because there are good reasons for the seemingly low returns. So firstly, it's because of the low interest rate environment in the past decade. And secondly, it's because of the rate hikes from 2020 to 2023. Both have presented headwinds to fixed income markets. However, the environment has changed. The higher yield in the fixed income market now probably presents more opportunities to investors than disappointments. And lastly, we all know that investments carry risk. So while the risk in fixed income assets is lower, it is not risk-free. You see that there is volatility and drawdown risk. And this is why understanding your risk tolerance is important and having a long-term investment horizon to stomach the short-term volatility is important as well. On your question of the historical payout, so I've tried my best to extend the history of the payout yield for the three portfolios. And you can see that basically the three portfolios have realized their payout targets historically. And in the past 1 year or so, it has stayed relatively stable because interest rate was elevated and the environment was rather conducive to income portfolios. A note to make, and I think I saw some questions as well. What happens if the rate, if there's rate cuts coming up? Would the payout yield for the portfolios change? So the short answer is that it might, because we actually monitor the payout target of each of the portfolio on a quarterly and monthly basis. And we do not try to stretch the payout target for the portfolio such that it becomes unsustainable. You don't want to pay more than the actual income of the portfolio because that means you're dipping in your own capital. And that's not the purpose of these particular portfolios. So if the rate does come down and if the income generated by the fixed income market and equities market come down accordingly as well, then we will see what is sustainable for the portfolios and adjust accordingly and communicate accordingly. Next slide, please. Yeah, so actually on the sustainability of the income portfolios, here is the portfolio characteristic statistics for the two fixed income only income up portfolios. And the fixed income component for income up growth portfolio would be the same as that of steady, and that's why I didn't put it here. But I think investors should be quite delighted to see the high yield to maturity of the fixed income component of our income portfolios. So the income up steady has currently a yield to maturity of more than 6%, while being mostly investment grade rated. And the yield to maturity for income up plus is more than 7% due to its higher allocation to high yield. So such yield to maturity profile also means that we can prove that we're not stretching the payout targets. And the payout targets can be sustained by the forward-looking total returns of the portfolios in the current environment.
Thank you very much, Yulin. And with that, some of the existing clients, you may be familiar with our previous passive income portfolios. So with existing clients, you will be able to adopt the new income up portfolios by following the few simple steps below. So for those of you who would like to upgrade your existing passive income portfolio to the new income up portfolios, you can implement these changes by clicking onto your goal and select Manage Goal, then Modify Goal. You can then add new funds to the portfolio, and you can search by the ISIN code or the fund name of each individual component funds. And lastly, you need to make sure that the allocation to each fund is correct before confirming and going to the next steps. For your ease of reference, we have also prepared a table here for you to come back and reference if you want to make changes to your goals according to the different income up portfolios. So let me quickly explain what will happen when you modify your income up portfolio goal if you are already a passive income portfolio investor. So what will happen is that we will redeem the funds that are no longer part of the portfolio or that are underweight to the new asset allocation and reinvest the proceeds into the new funds to align your portfolio to the new asset allocation. At the same time, we'll also take this opportunity to rebalance your portfolio as part of our added service, and this whole process will take about 5 to 10 business days to complete. So during this time, you can still invest and partially redeem from this goal, but you cannot do a full redemption until the whole process is completed. So you can take your time to understand why we're making these changes, and you can go ahead to implement the update at any time, any point in time, or you can also choose to remain in your existing portfolio. And if you have any questions as well during this process, please feel free to reach out to the team at support.hk@endowus.com, and we're always happy to answer any questions you have on your portfolio. And as for any new investors or new joiners to the Endowus platform, you will also be able to invest into the income up portfolios by following the few steps here. So you can go after you log into the platform, click on Invest, Redeem, Transfer, and New Investment. You will then be asked to select a few different questions, such as your time horizon, as well as your risk tolerance. So after you go to the next step, you will be able to see a list of different model portfolios on the top section highlighted in the blue bracket. So you can select the income up portfolios that are suitable for you. Maybe it is steady portfolio, or it could be the plus portfolio. So for this example, I'm using plus as an example. We will also show you the characteristics as well as the allocation to each individual fund, as well as a high-level risk rating for the portfolio, as well as the fees that are charged by the fund and also Endowus as well. So after you confirm these details, before you confirm the investment, you can also make tweaks, if you like, to the allocation to the underlying funds. So after reviewing all the details, you can then go ahead and invest into one of our income up portfolios. So that's all we have for the webinar section. And we want to move on to the Q&A now. So for those of you who have any questions, please go to Slido, so that's sli.do, and put in the event code IncomeUp to put in any of your questions. And for existing questions, please do feel free to upvote any questions that you think are most pertinent so that we can also prioritize those ones to look at. So while you are sending us the questions that you have, to start off with the conversation.
Sorry, I can't hear you anymore.
Hi, sorry, can you hear me now?
Let me.
Hi, can you hear me?
Can you speak again?
Okay, yeah. So while you're sending us the questions that you have to start off the conversation, so Yulin, I have a question for you. We've been getting quite a lot of questions on the difference between income investing and annuity plans. So Yulin, can you highlight some of the key differences of annuity plans and income investing for us?
Yes. Sorry for the technical issue. Can't believe that we are still facing it after 3 years of COVID, post-COVID. But yes, I'm really happy to address the differences between income portfolios in the form of, like mutual funds versus annuity products. Actually, I've been thinking about it a lot because I know how popular annuity product is, and I did some research as well. So, yes, we actually have prepared a table to summarize the differences between the two. I think on a high level, annuity product is very targeted towards retirement, and generally, there is this accumulation period where you pay annuity premium every year. And actually, the insurance company will invest your annuity, right, to generate investment return. And after maybe 10 years or 20 years of accumulation stage, you will start decumulating. Which means that they will be paying you a steady stream of income for the next 10, 20 years. And there's different structures to that. So it's good for those who want a steady stream of income for the long term, and it's suitable for those who are retiring. However, I think the key drawback for annuity products is the high fees and non-transparent fee structure as well. And also, it's very inflexible. If you want to, for example, surrender it early, you have to pay surrender fee. And to be honest, as someone who is in the investment industry, what I would like to know more is exactly what they're doing with my investments. I want the transparency. I know on a high level it might sound, oh, hey, it's a very hands-off thing, right? I came up with this analogy of greenhouse versus planting your own garden. So I think annuity product is like having a greenhouse, buying a greenhouse. So you are guaranteed by the greenhouse operator that the plants are going to grow at a certain rate after a while. And it's great. However, and you don't need to do much work, but it's very expensive to set up and maintain a greenhouse. Just like you need to pay management fee, insurance premium, and if you're surrendering charge to the operator. And also, it's very inflexible because if you want to make any changes to the greenhouse, it's a lot of work, and it can be very restricted too unless you pay for it. Whereas if you think about income portfolio, like the Endowus IncomeUp portfolio, any other kind of portfolio of income funds, it is more like taking care of an outdoor garden. So instead of doing the work yourself, you hire Endowus as your cheap labor to do the work for you. So Endowus have designed a flourishing garden based on your needs, ready for you to enjoy and cherish. And importantly, you know exactly what is going on, and you know exactly how much it costs. However, you would also feel the impact of external factors like weather, soil quality more. And it's just like you will experience the market fluctuations of IncomeUp portfolios firsthand. But you will see the fruits in terms of income, but also sometimes the withering of a few branches, just like the fluctuation in your capital. Actually, I'm not saying that annuity products won't be subject to the same kind of risk. It's just that they don't really tell you and you don't really see it. And also, I think the good thing is it's much cheaper to do an outside garden, and a well-tended garden can produce a much more bountiful harvest, right? There is much more flexibility as well. You can decide to harvest at any time, put your resources elsewhere, or plant more seeds for more harvest in the future, similar to how you can add, redeem, adjust your investment portfolio at any time with no lockups. So hopefully that gives you a sense of the differences. And annuity plan has, a lot of varieties. So I'm sure our client team would be happy to do an in-depth comparison for you if you're interested to know the differences of our Endowus portfolio and the other annuity products that you're looking at, and give you a fair and objective assessment.
Yes, thank you very much, Yulin. And thank you for the analogy for the greenhouse example. I think I personally get quite a lot of questions around this as well. And some of the key differences comes down to the flexibility as well as the low fair fees of investing in a fixed income portfolio rather than compared to an annuity plan. So let us go back to the page here. And if you have any questions, please feel free to ask on Slido or down in the comment section as well. So maybe to start off with, I do see some questions coming in already. So maybe I will start off with the most upvoted question for you. And I think this is already partially answered in one of our slides for your analogy for the bus ticket. So one of the clients asked, the returns for the cash up portfolio and the income up portfolio look similar. So what's the difference and how should I choose between the two?
Yeah, to begin with, the moderator helpfully answered the investment objective is different. Cash portfolio is for your short-term cash that you can put away for 3 months, 6 months, but you need it, right? After that time period, it's for your emergency cash, for the amount of cash you need to pay for your house down payment in 6 months. So that's cash up. And for income up is for your long-term income needs, passive income needs. It's meant you need to have a long-term investment horizon for it. And sure, I think I kind of addressed the concern on similar return. It was similar for the past maybe 1 year. Actually, IncomeUp portfolios outperformed cash in 2023 already. And the reason is because people were expecting rate cuts. So it's not always going to be similar. And the reason is because interest rate environment fluctuates, and that will actually impact both portfolios to a different degree. Maybe we can go back to a previous slide that I prepared, but we didn't have time to talk to. Slide 23. Yes, this one. So I did an analysis on the asset class return after 1 year after the end of the hiking cycle. And the dark blue bar is fixed income, which can be used as a proxy for the IncomeUp portfolios. The green bar is cash, and the light blue bar is equities. So in the historical period, no matter how the interest rate environment turned out to be after the end of the hiking cycle, in most of the time, actually fixed income outperformed cash, right? Because there's the capital gain element for fixed income when there's rate cuts. And fixed income also offers more stability in terms of, more certainty of outperforming cash compared to equities. I think that I hope this gives you some idea as to how to think about income portfolio versus cash. and what is suitable for you.
So we also have one question from another audience asking that on other platforms, they see income portfolios that distribute much higher, closer to 10%. So why aren't we offering this level of income in our IncomeUp portfolios?
Yeah. I'm always skeptical when I see a 10% payout, to be honest. Because if you think about the long-term return of asset classes, equities past 10 years, if you look at the best performing equity market, S&P 500, it's merely performed 10, 11% with a lot of volatility. And for a more stable portfolio, like a fixed income portfolio, the long-term return, if it's investment grade, it's probably 4 or 5% across a market cycle. So the question is, how do they pay you 10%, right? Where does the additional income come from? Yeah, I think the answer is pretty simple. It's from your own principle. Yeah. So you put in $100, the long-term return gives you maybe maximum $110 after a year. And then if someone is telling you, I'm paying you 12%, they will pay back to you, and they will also supplement with $2 from that $100. So yeah.
Yeah, that makes a lot of sense.
We're not trying, and this is not, we are not in this business. That's why we are not doing this kind of crazy payouts. Yeah.
Thank you very much, Yulin. I do see quite a lot of clients, especially clients based in Hong Kong, who are drawn to high payout ratios of 6 to even close to 10%, as one of the audience pointed out. But usually they also need to pay attention to how the fund price or the NAV moves over a long-term period, especially if the fund is moving down or trending down in the long term, especially the NAV can be eroded if the payout ratio is unsustainably high. So another question I think is also quite interesting as well is an audience is already holding some bond funds, or they already hold a fixed income portfolio. So how do they consider income up, and how does that fit into the overall investment portfolio?
Yeah, this is the question on if someone already has some bond funds, how does IncomeUp portfolio fit? Is it? Because I actually lost you for another 30 seconds. I think the internet is a bit unstable here.
Oh, sorry. Yes, that's the one. So if the client already has some bond funds, how does income up fit into the overall asset allocation?
Yeah, that's a good question. And well, it's really difficult to say without more information, to be honest, on the particular client. Well, most obviously, if there is income needs, then the client should probably consider income up portfolios. If you don't have any income needs, then the question is, what is your risk tolerance overall? Do you have enough bonds to dampen the volatility of your overall portfolio? Because that is a very important role that bond plays in one's overall allocation. And then we can start from there to see what is suitable for you.
Yeah, thank you very much, Yulin. And I think we also have a question on leverage. And I think our client advisory team has already answered that, but I also want to address that on the video as well. So one of the audiences asked if they can apply leverage on the portfolios. So the answer is that leverage cannot be applied on Endowus. And we believe that leverage is not the best strategy for long-term wealth building. So it can magnify the risk of your overall investment portfolio. We want our clients to invest for the medium to long term and also sleep better at night, so that they don't have to worry about their investments and look at the investment portfolio value on a daily basis. So the answer in short is that no, we do not offer leverage on our portfolio.
Yeah, and I think leverage is really expensive now as well. So I'm not sure whether
that is a good way to do the investments in the current environment. Yeah.
So, and then for the, I think we have two other questions. So maybe we'll address the two of them. One is on fee saved. So one audience is asking how is the fee saved? So we showed earlier, maybe I can go back to the slide as well. How can we achieve the fee saved that we're showing on the slide?
Yeah, this one. Yeah, I think we've kind of touched upon how it's achieved. So it's either through access to institutional share class of the fund. So I give you an example, a very concrete one, and that is the PIMCO Income Fund. It's very popular amongst investors, and it is a good fund. But if you buy it on through other distribution channels, you get the retail share class. And how much does retail share class cost a year? 1.45% a year. However, we have very good relationship with PIMCO, and because of this, we actually have access to their institutional share class. And how much does that cost? 0.55% a year, and that is 0.9% difference a year already on this one single fund. So that's the first route of fee saving, institutional share class access. The second route is trailer fee rebate. Let me give you another example. Is there any fund? Okay, just a simple equity fund. For example, I think AB low vol, which we have in future income portfolio. If you buy it on other platforms, I remember it to be 1.5% management fee per year. Yeah, don't hold me to it. It might be 1.25%, but it's around there. However, actually, it goes to the fund manager, Allianz Bursting itself. Half of it, so 0.75%, will go to the distributor, the middleman, and they take it, they pocket it. That's their commission, right? So we don't do that. We will rebate back the 0.75% back to you. So we don't take any of it. So the net cost that you enjoy for this equity fund will be 0.75% management fee. That's how we do it. And so I think we make money, right? Like if we just like give everything back to our investors, how do we grow our business? How do we pay our employees? And that is why we are a fee-only platform. It means that we don't try to earn from both sides. So normally a distributor, they earn from fund managers by taking the commission. They also earn from any investors by charging sales fee, by charging platform fee, and it makes their incentive and interest not aligned to the end investors. Is my internet okay?
Yes, thank you very much, Yulin. So I think for the rest of the questions, we do have a few on the breakdown of the IncomeUp portfolios, as well as the some specific questions on the credit quality of the portfolios. So we have touched upon those topics. I think our audience can also go to our insights article on our webpage, where you can also find more information and also details of the IncomeUp portfolios as well. And with that, I think that's all the questions that we have. And thank you so much again for your time during lunch hour. And any follow-up questions, please feel free to reach out to the client advisory team, and we will get back to you on them. Thank you and have a good day ahead. And thank you, Yulin.